Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, May 1st, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is RIP to our Jay and Janet want a soft landing thing. So the nuance there is that the FOMC statement and the Powell presser this afternoon are likely to confirm USD money market pricing of a much more tepid policy normalization cycle. At 8:30 a.m. today, the U.S. Treasury released Part 2 of the quarterly refunding announcement. Part 1 was unequivocally hawkish. Part 2 was even more hawkish. So in terms of market implications, higher for longer is not just bearish for the bond market. It also means the $534 billion of excess liquidity trapped on the Fed's balance sheet in the form of the RRP has little reason to exit anytime soon, given the relative attractiveness of the 5.3% overnight repo reward rate. Because of the relative attractiveness of financing itself in the bill market, the Treasury's decision to increase coupon and bond issuance instead of continuing to overwhelmingly supply the market with bills is a telltale sign of their hawkish intentions. Biden wants, rather needs, a series of lower inflation prints ahead of the election in November. He appears to have convinced Secretary Yellen to get on board with tightening financial conditions as a result. So as always, we're wrapping up, transitioning to our 42 macro dashboard here. Just wrapping up with the question from our community regarding Treasury buybacks. It says, hello, Darius. Now that the details of the buyback program have been released, how material of an impact will it play on the long end of the curve? It appears the amounts may be relatively insignificant, but I'm not really sure. So this is unlikely to have a significant impact at all for the bond market and for broader financial markets. Again, this is not a duration swap whereby the Treasury issues shorter duration instruments and to buy back longer duration instruments. What they're doing is releasing or issuing on the run securities to buy back off the run securities. And what we mean by on the run is the bonds that are heavily traded, like the 10-year note, the 20-year note, the 30-year note, as opposed to like the 11-year note or the 13-year note or the 17-year note. They're trying to get rid of those bonds that have less liquidity because they tend to be less traded and less trafficked in broader financial markets. Those bonds tend to be held to maturity. So what the Treasury is trying to do here is just increase the reduced amount of trading friction in the market. So it's positive at the margins in terms of swapping off the run notes with on the run notes, but it's not like it's going to have a significant impact in terms of broader U.S. liquidity conditions. So hopefully we can put this discussion to bed after today. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, May 1st, 2024. I'll be joining our friends at Real Vision for the daily briefing this afternoon at 4 p.m. Eastern to unpack the Fed, Treasury, everything else that's going on in global macro. So definitely tune in. We look forward to catching you there. And everyone have a wonderful day. Catch you back here tomorrow as well. Cheers.